Hello and welcome to the August edition of the Client Market Update. Every month I try and put together some of the information that I seek to find as some of the most helpful, as well as share some different data points I'm looking at. This month in August is really going to be focusing in on what's happening in our current market environment as well as inflation changes. So with that, let's get started. The first slide that I want to look at is really looking at the information as of the end of June 2022. And what I'm looking at here is when the equity market, or how the equity market was down a little over 20% at the end of June. Let me get this out of the way. Here you go. At the end of June. So with the equity markets down about 20% year to date, and now they're down about 12 to 14%. The current market decline is really, of course, primarily driven by too high of inflation as well as too high of interest rates, which is causing a repricing of investments that we work with. So while I fully understand and fully realize that being down 5, 10, 15, 20% and so on isn't good in any sense, all right? But let me ask you this basic question of which would you choose, all right? So given the choice, would you choose today's current market environment of being down roughly a little over 12% or close to 13% since the start of the year, or rather, would you choose 2020 and calendar year 2020, the COVID-19 recession? Right, where in about 33 days, the market dropped about 33%, as you can see on this chart. Or another option is, would you choose the global financial recession of 2007 to 2009? Right, as you can see on this page here, where over these couple of years, the market dropped close to 54%. So for me, and as well as talking with other clients, I find that the choice is rather easy, and I have to assume that most of us is going to go with our current market sell-off. Now, I want to be really crystal clear on this. This does not mean under any sense that I like our current market environment. But when I look at the past 50 years of historical market data, all right, and really the reason I'm looking at the past 50 years is that there's been other seasons of high inflation and there's been several seasons of significant market declines. But when I look at this and I think, okay, from July 1972 to July 2022, what's happened, right? And of course, one big item I'm looking at is the CPI change, right? The Consumer Price Index change. And so when you say 41 to 297, that's about a 7 times increase. Now compare that to the S&P 500 price of 107 to 3,900. Well, that's an increase of 36 times. S&P 500 dividends going from dividends going from 3 to 64. Dividends are up close to 21 times, and then S&P 500 earnings, very similar story here, going from 6 to 196. Earnings are up 32 times. So, and of course, keep in mind that over the past 50-year period, the S&P 500 has dropped about 50% on 3 separate occasions, 3 separate instances. And it's also worth mentioning that our economy has a bear market about every 4 to 5 years. This chart here is something that I look at and post regularly for my clients. And it's really because I want people to understand that, yes, the market does move in 2 different directions. And as a reminder, over the past 50 years, the S&P 500 has dropped about 50% on 3 separate occasions. And we have a bear market about 4 or 5, every about 4 or 5 years. And so the question, though, that I think a lot of times people don't think about is, so if it's true we have a bear market about every 4 to 5 years, which is true, then what happens on the other years, right? The years that we don't have a bear market? Well, my conclusion is that we go up a whole lot more than what we go down. Now, as we think about that, though, a common question that I'm getting is, are we still in a recession? The common question I'm getting is, are we in a recession? And according to the NBER.org, we are not in a recession, at least not yet. The NEBR looks at the depth, diffusion, and duration of the business cycles. Just think like economics, really to determine if we are in a recession or not. And regardless if we're in a recession or not, I want to be clear on this as well. This really doesn't change our long-term investment strategy. Your investment strategy with me, if you're a client with me, is long-term and goal-oriented. However, if your goals have changed, right, if you're a client of mine and your goals have changed, please contact me immediately so we can assess if your investment strategy needs to change as well. But then a lot of times I get asked the question of, how long do recessions typically last? Okay, and this is where the chart I want to put up on the screen that I'm sharing now. Get myself out of the way again. Okay, how long do recessions typically last? And I think we should be asking, how long in comparison do expansions after recessions typically last. And as you can see from the chart that I have, the average length of recession is 10 months, and the average expansion is 64 months. Okay, now we don't know if there's going to be a recession. We don't know how long the recession is going to be. We don't know how long the expansion is going to be. But what I do like looking at are the averages of trying to understand, okay, this is what's happened in the past. Got it. We don't know if that's going to continue to happen in the future, but this is where I have optimism about long-term equity investments. Now, another common question that I'm getting right now is when or how does inflation cool off? Well, and the bad news, and this is something that I've shared, time and time again, is that the cure for high prices is really high prices. And high prices have historically curbed the consumer demand because people just don't have as much to buy. And additionally, high prices also help soak up some of the excess money supply in circulation. And so today on this chart that you see in front of you, we certainly have high prices. And when we look under the hood at the level of money supply, all right, this is the black M2 line that you can see, compared to inflation, the red line, as you can see here, okay? Because we certainly have high inflation, and it does appear that with the money supply starting to cool off, all right, when you're tracking these two lines and looking how they run together, my guess is that as the money supply has really cooled off, that inflation has come up. I wouldn't be surprised if it's peaked or peaking now, and will hopefully start to follow off as well, because we are going to see, and my guess is we're going to continue to see a correlation between these two. However, there is still a significant amount of lag as far as period of time. And then thinking of, all right, what is inflation and what is it going forward? The 5-year break-even point, as published by the Federal Reserve, as you can see on this page, is 7.27%. All right. And I personally have optimism that our current situation of high inflation is really going to run its course, and that we're going to revert back to normal on this. But, as we think about inflation, as it has to do with value of the dollar, and this is one that I don't see a lot of people talking about, is that when you think of inflation with the value of the actual US dollar, because, the reality is that we know that inflation is a decline in your purchasing power, right? You have a dollar. You can't buy as much today as you could just a year ago, right? So when there's inflation, it's a decline in the purchasing power of the dollars that you have. So it does make sense to think that when we have a period of high inflation, the global value of the dollar would also go down. At least, right? That makes sense. Well, it may surprise you and a lot of people that the dollar is close to a 20-year high against the value of the euro, and the euro has lost parity with the dollar. This has happened for the first time. This happened the first time since 2002. So keep in mind that a strong US dollar is something else that's going to help up this extra money supply, this extra M2 that was printed in the past couple of years to help battle COVID. All in all, and kind of in closing on this, I feel these are really good signs to help cool off inflation. So these are some of my prepared comments as far as looking at some of the economic data. There are 3 additional data points. Something that's been really popular over the past couple months is sharing some of the additional data points that I'm looking at. This month I have 3. The first one is looking at retirement expectations. This is information taken from CNBC.com of looking at what are some of the greatest over concerns or under concerns that retirees have when looking at market volatility as well as longevity. Another interesting piece is published by Yardeni Research, and Yardeni is looking at S&P 500 profit margins. And what you can see is that we have this long upward and to the right movement, right, from 94 to present. And yes, I do see that we have this slight decline here. However, when I look at the long-term average, this is really where I get excited of thinking about the long-term movement of profit margins. And then the third and final is from JP Morgan. This is something that I also published last month, and so you can go back and look at the comparison of the two. But last month, you can see this PE ratio here, and last month was kind of this like sharp down tick right here, where we went below the 25-year average, and so now we are just above the 25-year average. When we think about PE ratios, this is not the end-all be-all valuation metric that we have in the market, but this is one of the core drivers to it. So with that in closing, I appreciate you tuning into the August update here with me at Hobbs Wealth Management. As always, should there be any questions, do not hesitate to reach out. Of course, I certainly cannot control what the market does from here, and we don't know. We don't have any clarity as far as what direction it's going to go. But what we can control is our behavior to these outside events and continue to stick with our long-term investment strategy. Should you have any questions whatsoever, do not hesitate to reach out to me. Thanks for tuning in. We'll be in touch soon.